I have not the least doubt that there is a good year to come. But the good year for somebody who invests on a longer term perspective is not the most relevant time span you should focus on. If you look at a perspective of 3 to 4 to 5 years, it is pretty clear that whatever the right, or even 6 years, whatever the right time period is, the times of zero interest or negative interest will stop. That may for the first time happen in the US when Fed is increasing its rate, immaterial whether that is in the last quarter of that year or the first quarter of next year. When it happens, it will be a signal to the market that basically the turn of interest rates has happened, even though that will take some years until it happens in Europe. But it is basically a little bit like in the theater when you're waiting after the large break for the performance to resume. You will hear that when the bell rings, you have to move. And that will give market participants some thoughts when that happens in Europe. From my point of view, that to happen 3 or 4 or 5 years away, but it will happen. When that happens, it is pretty clear that the discount in future cash flows is no more zero, but it is, I don't know, 2% or 3%, which will definitely lead to a decrease in asset values, or as you may say, to a better risk pricing of asset values compared to what you do now, which is, from my point of view, clearly not a risk-adjusted pricing. When that happens, we'll have a time and a moment of reassessment of prices. I don't expect them to fall endlessly, but we'll see a different environment and we see a readjustment. And when that readjustment happens, we may find us in a different situation. That is, of course, something that an investor clearly has to have in mind today, because he will not invest for a year's perspective only.